Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, and I am on the line with Brad Thomas, and he is editor at iREITinvestor.com. Brad, how you doing this morning?
I'm doing great. Have a little jet lag, but I'm surviving.
Okay. Hey, I just got to check in on you. How'd your golf game go the other day?
We're really good. Thanks for asking. I was in Scotland, and I got to play at two of the most really iconic golf courses in the world. One's a new course that Donald Trump developed up in Aberdeen, and then I went over to Turnberry as well. So golf game's in good shape. I did set a record for losing the most golf balls in a day.
Yep. I bet you if I played those courses, 24 balls would not get me through them with all that thick grass. But let's just, talk about your site and what you write about. Obviously, is about the REIT market. Just give us a little background on your site and why you're a lifelong student of Benjamin Graham.
Sure. Well, first, Joel, I was going to give you a little news this week. When I was out of the country, my daughter sent me an email, and there was, I think it was yesterday or maybe 2 days ago, it was reported that S&P is considering including REITs as an 11th sector in their index system. So right now, REITs are rolled up in the financials, and I really think this is going to be big news for the REIT world to have S&P consider REITs as their own sector. So and I'll be writing on that topic here this week.
Where are they at from a dollar standpoint? How big of a part are they of the financials? Do you have that just off the top of your head? Must be a pretty big part of it.
No, I know. The REIT space today is just under $800 billion, and it's amazing to see the growth even over the last. I've been writing now for 4 or 5 years, really coming out of the recession, and just to see the strength of the market and how resilient the REIT market has been. I mean, this was a great recession, and a lot of companies got wiped out, not only REITs but banks and a lot of financial-driven companies. So it's a very resilient market. I was actually in London this past weekend speaking at the Money Show, and the REIT market in London is about 1/10 the size of the U.S. They are not as mature. REITs were in London. The REIT laws were passed in 2007, just 7 years ago, and of course they had the Great Recession too. So they're really just starting to get traction in that country. But in the U.S., the REITs have been around since 1960, so over 50 years that we've evolved into this space, which again now is about an $800 billion industry, and you're just seeing a lot of companies converting to REITs, a lot of non-traded REITs, a lot of IPOs. So it's definitely evolving into a very massive sector for investors to diversify.
You know what? It seems to me though, and correct me if I'm wrong, that it's I don't want to say a sham, but you've had a couple companies like. Did you see the move in Sears? Because of what they're thinking of doing. I mean, spikes up to over, $48 or something like that, and now it comes right back down. It just seems to be like, well, if you say you're converting, I mean, you had it with CTL, CenturyLink, had just a ridiculous move. Windstream kicked everything off. It just, I don't know, are some of these companies using it as a ploy to boost their stock price?
Yeah, I mean, it's Sears owns a lot of real estate, and that doesn't surprise me. That's been a discussion for a long time. One thing I'll say is that when you look at the history, and again, going back, especially in the U.S., where we've got such a history to rely on, and when I see companies like Sears converting, there was some talk about, if you remember, over a year ago or maybe less than a year ago, about Red Lobster spinning off into a REIT, and at the end of the day, that really doesn't make a whole lot of sense. And I think for Sears to have kind of a one-tenant business model, that's not going to trade in line with some of the other, net lease or single-tenant REIT peers. So, I'm not going to say that I don't think Sears, will convert to a REIT. Who knows? And I haven't really studied this in great detail this week with the announcement, but having one tenant with no diversification makes no sense at all. And there are a number of REITs that can provide the same, if not much lower cost capital and buy those properties and under a sell-leaseback type structure. So to me, it just seems like it makes more sense for a REIT to purchase those assets, create the liquidity for Sears to continue their business model and try to evolve in the face of all the internet competition. So I wouldn't call it a sham at all. I would just say that, there's definitely a demand for income in the form of real estate. And certainly that's why you're seeing companies like Sears looking or considering, that type of structure.
Okay, now let's talk about the stock had some big news on it at the end of October. ARCP, American Realty Capital Partners. When you come out and say non-reliance on previously issued financial statements and changing in accounting personnel, that's not something the street likes to hear.
No, it isn't, and it was a shock to a lot of people. But what's more of a shock is what I would consider to be more of the domino effect, where now you're seeing a number of things pop up, and the ringleader for ARCP, the founders, a guy named Nick Schorsch, and I've written on Nick as well as quite a few of his companies. And as you recall, or as you know, he is also the founder of another company called Realty Cap Securities, which is a public company that basically raises capital for a number of non-traded REITs. And so their business is more driven by load or fees. It's a fee-driven model. And so what's happened with the ARCP news, ARCP was already tight with paying their dividend coverage. I had written quite a bit about the company, and even about a week before the news broke, I actually went out and wrote an article informing my followers and subscribers to really look hard at this company, because I knew the dividend was really tight. They're paying about $1 a share in dividend, and their profits are what we call adjusted funds from operations in the REIT world is just about $1 a share, so just over that. So it was a really tight payout. They are paying a high dividend, but it's what I termed a sucker yield, and actually created that term. I write for Investopedia, so you can now find that term on Investopedia. But anyway, so what happened is, all these dominoes started to fall. I mean, certainly the accounting scandal that you referenced, then we had the fallout. Now there's a lawsuit as of yesterday that, ARCP is suing Realty Cap Securities. There's a business that ARCP owns called Cole Real Estate, which is their single tenant net lease non-traded REIT fund that aggregates capital for their non-traded REITs. And I've already there's a fairly large number of conflicts of interest within ARCP and Cole, and I've written about that quite a bit. And so it's a very complicated series of events that are out there, and it's going to take time. And there's a lot of market timers jumping on ARCP. The stock is trading at I haven't checked it in a while, but it's trading in the $8, $8 to $8.50 range last I checked. And so it's paying a double-digit dividend, but it's definitely a yield-chasing proposition. And I wrote an article right after that news broke, and I sold all my shares in the ARCP just because it's become a very speculative play. And as you mentioned, anytime you have that type of accounting issues, it's definitely something you should consider.
So you were in it, and then when the news came out, you just dumped it?
Yes, I did.
Okay. No, I mean,
it was, like I said, I mean, I'm a very conservative investor and analyst, and I look for the companies for long-term play, and I just felt like until there's too much drama unfolding, and I think you're going to continue. They have the FBI now involved. They have SECs involved, and things like that take time. If there's any other news that was to surface with ARCP or with Realty Capital Securities, and you're seeing that in the non-traded REITs. A lot of the companies now are not selling programs for Realty Capital Securities, and it's just really becoming a tremendous mess. And so I'm definitely avoiding those companies right now.
No, just good lesson to be learned there for our listeners. I mean, you were in it. The news came out. You were skeptical about it before. You didn't like the news, and you washed your hand of it. You moved on, and I think that's a hard time. Investors have a time when things like happen like that. It's like, oh well, it's gonna come back, or the news isn't that bad. But it's good. It's just to wash your hands of it and move on. So, all right,
Yeah, exactly. And I will say one more thing. I mean,
sure.
the current management at ARCP is led by a guy by the name of David Kay, and he is, I know David. I've obviously written on the company quite a bit, but he became the CEO recently, so he really stepped into the shoes, much bigger shoes than he thought he was stepping in, and I think he's really doing a good job. I'm sure he's under a lot of pressure right now, and but I think if anybody can't turn the ship around, it's him. But again, I'm just going to have to wait on the sidelines until I see some of this dust starting to settle.
Okay, just moving on now. Within the REIT sector, there's kind of like subsectors, right? And
Right.
was there any here that of the subsectors that you think might be a little bit undervalued?
Sure. Well, I think today, I've written a lot about the manufactured housing space. That's, a lot of people think they're mobile homes, and they're not. They're these are actually houses that are attached to land. And Warren Buffett owns Clayton Homes, which are some of the manufactured homes that are occupied. So I like that sector. You're seeing pretty strong growth year to date. Off the top of my head, the sector's up about between 25 and 30%. And so that's a very durable business model. There's really three smaller companies. Again, a lot of people forget about the manufactured housing space, but you've got a company called Sun Communities, you've got Equity Lifestyle Communities, and you've got a company called UMH Properties, which is the smallest based in New Jersey. So I like that sector a lot. And like I said, we're seeing very strong growth in that sector. I like campus housing. It's also another smaller sector that's often ignored. There are three players in the space. One of those, Campus Crest, their CEO was just let go, as well as their, I believe, CFO last week.
What's the symbol on that one?
That's Campus Crest is CCG.
Okay, go ahead.
CCG. And so, that company's really traded down into, last I checked, they were in the $6 to $7 range. Around 30 to 40%. They just had a number of management issues that have taken place. They bought a big portfolio up in Penn State, Pennsylvania, where they're based. This company they acquired, and so they probably shouldn't have got involved in that deal. Then they went up to Canada, got involved in development, and REITs in general are most REITs that have development usually don't work. And this is a good example. They just were not able to perform, and they basically have shut down their whole development operation. So I would avoid that one today. But the other two, I definitely like. American Campus Community, the largest. Their ticker symbol is ACC. They're headquartered in Austin, Texas, and actually I interviewed with the CEO Bill Bailiff last week at REIT World in Atlanta, and just discussed their earnings, and they're doing very, very well. So I like that. I like that particular company best, American Campus Communities, and in that space, the campus housing space.
And what's the third one?
The third one is Education Realty Trust. Ticker symbol is EDR, and they're based in Memphis, Tennessee. They're a little smaller. They're a good operator too. But they had a dividend cut a while back, and ACC has never cut a dividend. That's one reason I like companies that if a company can increase their dividend, especially during a recession, that tells me a lot. It tells me that they've got an alignment of interest with investors and shareholders. And when it comes to American Campus, they have really done that. They performed. And as I said, I really feel like they've got an alignment of interest with their investors.
Okay, and any sector, subsectors that maybe. I mean, you mentioned the ARCP, something like that. Is there anything else that is looking a little frothy to you?
Well, one sector that I think is again ignored a lot, and really people just don't understand the sector is the data sector. And when you look at the growth in the demand for data space today, whether it be Facebook or Twitter or Google, and all of where this whole industry is evolving. You've got to have a place to store this cloud. I mean, there's actually these data REITs store the cloud information in these buildings, and so
I thought they were in the clouds.
Yeah, well, there's actually today. I don't think we have any REIT clouds.
Okay.
Maybe we'll have one of those. Maybe there'll be one of those soon. But seriously, I think Digital Realty is the largest. They've got over a $10 billion market cap, based in San Francisco, obviously, and they're a global concern. And I like that company. There's some smaller ones, DuPont, Fabro, and CoreSite. I think 2 or 3 other smaller ones, but I've really been following Digital the closest, and I do own shares in Digital, and I've been very, very pleased with the performance of that company.
Any Canadian REITs you follow?
Yeah, I'm starting to really reach out more. I've had a lot of newsletter subscribers. I'm actually all over the world in terms of my subscription base, and I've got a number of followers or subscribers in Canada. The interesting thing about Canada is that it's really more of a retail investment model. There aren't too many institutions that invest in Canadian REITs. So it's about 1/10 the size of the U.S., so very similar to London in terms of the size. But what's interesting is because of that retail investor composition in Canada, most of the REITs pay monthly dividends, and that's kind of an attractive proposition for a lot of investors because they can basically match fund their dividend income with their living expenses. So, and certainly the power of compounding works best as well in a monthly paying model. So a number of the Canadian REITs do pay monthly. I'm just starting to get into that space, working with a couple analysts up there who are a little more experienced in the REITs that I'll be covering. But there are definitely some opportunities in Canada. One company in particular that's you've got some taxes, and I'm not an expert on tax law, but you do have to pay taxes. Obviously, you're investing in Canada and not the U.S. But there's one company that I've recently written on. It's called a WPT Industrial. They are actually based in the U.S., but they are traded in Canada, and they're traded in as well as the U.S. So you can invest in without having to go through the complicated tax structure.
You have a symbol?
It's WIR.U. WIR.U.
Okay.
And again, they're traded in the U.S. as well as on the Toronto Exchange. But their assets are owned in the U.S. So basically, they listed in Canada because they felt like that was where they could get better traction when they went public. And they're paying a fairly healthy dividend. I interviewed with the CEO again last week at the REIT World, and they're paying somewhere in between 7% and 8% dividend. They buy industrial properties, really from all the way down to Texas, and these are large logistics and distribution facilities. So I'm really starting to get into that space. That one is a little easier for me to research because they do own assets in the U.S. and they are traded in the U.S. But I'm definitely going to be expanding research there, and as well as Hong Kong and quite a few other markets. There's around 25 countries today that have REIT-like structures. So certainly creates that diversification for investors.
All right, we're bumping up against the clock here, but just real quickly, this public storage sector's been on fire. Are you looking for it to continue?
I'm sorry, you said self-storage?
Yeah. I said public. Yeah, self-storage.
Yeah. Okay,
EXR, PSA, Triple S.
Absolutely. That demand is out there. And I wrote an article a couple months ago kind of comparing one of my favorite self-storage REITs, which is Extra Space, ticker symbol is EXR. I was comparing that company, McDonald's, back in the 60s. When McDonald's started and they had their franchise and they rolled out all over the country, rolled out their business model. You saw the Golden Arches. That's kind of how I look at Extra Space. They've got about 1,000 locations now, and they could double it in size across the country. Tremendous demand. Really recession-proof, and they actually perform well in recessions. Although I'm not calling the next recession, but they do work in a variety of different market cycles, good, bad, or where we are today, somewhere in between. So I think there's a lot of demand for that space, and I like Extra Space. They've been the top performer for a number of years. Their fundamentals are really stronger than their other three peers. Public Storage is a good company, but they're just they're not as strong, frankly, and they
Okay.
haven't performed as well as Extra Space.
All right, Brad Thomas, editor at iREITinvestor.com. Great information, Brad. Thanks for coming on, and we're going to get you back on again soon.
You bet. Thanks so much.